It's been a low vol environment. I mean, the macro environment has been low volatility, so growth and inflation, they've been wobbling around a little bit, but actually, in historical context, they've been actually pretty stable. Of course, on top of that, central bank support to markets has been, making the market environment a low volatility one as well. There's a couple of things we'd say about the value of bonds in this environment. We talked about the risk of bond yields going a little bit higher, and that's our sort of central view. But there are a couple of things to say. Firstly is that the value of bonds has already improved a little. Yields have already gone up. US 10-year yield is close to 3%, coming off a low of less than 1.5%. So yields have lifted and values already improved for bonds as a standalone asset. It's also improved in relative terms, relative to other assets. So, bond valuations have improved, but other assets, equities in particular, have stayed pretty expensive. Thinking about a broader portfolio, thinking about diversification you need in your portfolio, we'd argue that the time is not necessarily to be thinking about removing bonds. We'd actually argue that relative value has improved, and you need to start to think about the time where you want to add back to bonds in your broader portfolio. As for US recession, look, we've done some detailed modelling. Recession's getting closer. It's been a long cycle. The Fed's hiking. Typically, there's a forerunners to an eventual recession. Our detailed work suggests that recession is still 18 to 24 months away in the US. So we don't think it's time yet to set your broader portfolio for sort of recession control, if you like. But to my earlier point, we do think it's time to begin to think about the improving value of bonds in a broader portfolio context.